Ladies and gentlemen, welcome to the Conceptual Framework for Financial Reporting. This is what I have promised in our first video that we are going to discuss the Conceptual Framework for Financial Reporting. It is one of the most important topics in accounting. So make sure you watch the whole video so that you can have a full grasp of the concepts that will assist you in navigating financial accounting. The outline of our discussion will be as follows. We will define the conceptual framework and also show you where the conceptual framework comes from and its purpose, and then we will cover the contents of the conceptual framework, and then we conclude thereafter. What is the conceptual framework on financial reporting? This is known as the statement of generally accepted theoretical principles which form the frame of reference for financial reporting. These theoretical principles stand as the basis for the development of new accounting standards and the evaluation of those already in existence. Where does the conceptual framework come from and what is its purpose or function? The conceptual framework has been developed and issued by the International Accounting Standards Body. It performs a number of functions, the first being the assistance of the International Accounting Standards Body in developing and revising international financial reporting standards that are based on consistent concepts. It also assists preparers of financial statements to develop consistent accounting policies on areas that are not covered by the specific standard. It also assists all parties to understand and interpret international financial reporting standards. Another function is to assist those who prepare financial statements to apply the international financial reporting standards in dealing with topics that have not yet formed the subject of an international financial reporting standards. It also assists auditors to come up or to form an opinion as to whether the financial statements comply with the international financial reporting standards. It also assists the users of financial statements in interpreting the information contained in the financial statements prepared in compliance with the international financial reporting standards. It also provides those who are interested in the work of the International Accounting Standards Body with information about its approach to the formulation of international financial reporting standards. Another important issue or point with regard to conceptual framework is that it is not a standard or an international financial reporting standard, and it does not overrule any international financial reporting standard. Where there is a conflict between the conceptual framework and the international financial reporting standard, the international financial reporting standard takes precedence. In other words, it overrides the conceptual framework. The contents of the conceptual framework. In 2018, the International Accounting Standards Board issued the framework with the following chapters. Chapter 1 covers the objective of general purpose financial reporting, and then Chapter 2 is on qualitative characteristics of useful financial information. Then Chapter 3 is financial statement and the reporting entity. And then Chapter 4 is the elements of financial statements. And then Chapter 5, recognition and recognition. Chapter 6 covers measurement. And then Chapter 7 is the presentation and disclosure. And then Chapter 8 is on the concept of capital and the capital maintenance. The objectives of general purpose financial reporting. According to the conceptual framework, the objective of general purpose financial reporting is to provide useful information to existing and potential investors, lenders, and creditors. The information will assist these investors and the lenders to make decisions regarding the provision of resources to the enterprise or the entity. And these decisions include, among other things, buying, selling, or holding equity and debt instruments, and providing or selling loans and other forms of credit. The decision of the investors or lenders or creditors who depend on the returns that they expect from their investments. One of the example is dividends, interest payments, capital increases, and the overall stewardship of their economic resources by management. These are normally referred to as the primary users of general purpose financial statements. Other users of general purpose financial statements are regulators and the public. The management of an enterprise is not regarded as a user of general purpose financial statements. This is so because they are able to obtain the information needed internally. You will find that general purpose financial statements sometimes have got some limitations, and the main limitation is that it cannot provide all the information that the existing and the potential investors and the lenders and other creditors need. So as a result, these users may be advised to consider pertinent information from other sources. The example is one of the examples, the general economic conditions and the expectations, and also political events and the political climate and the industry and the company outlooks. It is also important that you understand that management is responsible to use the economic resources provided in such a way that the resources are protected from unfavorable effects, and that the entity complies with the relevant laws, regulations, and the contractual obligations. This is normally referred to as management stewardship role. Another important issue with regard to the objective of general purpose financial reporting is that information provided is furthermore based on the accrual concept or accrual accounting concept. This concept implies that transactions and events are depicted in the financial statements in the periods in which those events occur. This is despite the fact that the cash receipts or payments for those transactions are done or occur in a different accounting period. I think from the discussion so far, there has been some indication that the financial information that is produced by accounting is needed by the users. So in our discussion here, we also need to discuss the users of our accounting information and their information needs. There are several users of financial information, and I think I'm going to deal with each category of user and the category of users information needs. So the first user of financial information that we can discuss are managers of the company. I think these are the persons who are involved in the day-to-day running of the business, they need the information about the company's current and the expected future situation for them to be able to make planning decisions. They are the ones who also generate the information. Then we move on to another category of users, and I think these are the shareholders of the company, and the shareholders are the owners of the business, and these want to assess the effectiveness of management, and also they also want to see how the company is performing in terms of profit, so that they can be able to assess their return on investments, and also to assess the risk that is involved in the business that they have actually invested their resources, and also to assess management stewardship of the resources that they have entrusted them to. And also they also would want to make a decision on whether to continue to stay in that business, that is, whether they continue to be invested in that business, given the performance of the company. Then another category of users are what we call trade contracts, or suppliers of goods to the company on credit, and the customers. So the suppliers would want to know whether the amounts that are owed to them can be paid when it becomes due. So in other words, they look into the financial statements of the company to assess the ability of the company to pay back the amount. In other words, the ability of the company to pay the debts. And then the customers need to understand whether the business will continue to be in existence, so that there will be no disruption of supplies. So the normal customers will be relying on the company for the supplies of goods and services, and as such they want to assess whether the company will not disrupt the supplies through either closure or bankruptcy. So customers are interested in the stability of the business, so that they have reliable supplies of the goods and services. Then there are also other users known as the lenders or suppliers of finance to the business. These may be in the long term or in the short term. The lenders are mostly interested in the ability of the company to pay back the money that or the funds that has been advanced to the business, and also whether the business will be able to pay interest, and also they will assess the risks that are involved in advancing the money to the business. Another user of financial information or financial accounting information is the tax authorities. The tax authorities are interested in the accounting or financial statements of a business for them to be able to assess whether or to establish whether the business has made some profit, to be able to establish the tax payable by the business. So that's the main concern of the tax authorities. Then another user is the employees. The employees need to assess the company's viability, so that they can be able to establish whether the business can be able to pay the salaries and also the terminal benefits in the event of the employee or leaving the entity. Then another important category of user is the financial analysts and the advisors. I think the financial analysts will normally provide some services to their clients, whereby they need the information to be able to assess the company, so that they can give a proper advice to their clients. Examples of these financial analysts, stock brokers, and then we also have what are referred to as the credit agencies. They would want to advise some credit suppliers whether the business they want to advance credit to will be able to pay back or to pay for the supplies that it would have been given. And also some journalists will also provide information to the reading public through the publications in the newspapers or on the radio or electronic media. Then another category of user is the government and its agents. The government is mostly interested in the allocation of resources and in the activities of the enterprises, and also the information that is provided by the companies will be used for the compilation of national statistics. So the government and its agencies have got such information need. Last category of user that we are going to discuss is the public. I think the public would need the financial information of a company or financial statements of the company to be able to assess its viability. The public normally benefit from a given company in the sense that it provides jobs and also It also buy from local suppliers, which means it will buy goods and services from local suppliers for its operations. And also the company may also affect the environment either through pollution. So they would want to assess the viability of the company. After assessing the viability of the company, they can be able to tell whether the company will be able to provide employment, or whether the company will be able to buy from the local suppliers, so that the local economy can also benefit. And also they would assess whether the company can be able to protect the environment, which means it will come up with some systems that ensure that it doesn't pollute the environment. So if a company is not viable, it will normally neglect some of these issues, like the prevention of pollution, or also the protection of the environment. Financial statements. Financial statements are known as a specific form of general purpose financial reports. The financial statements contain information about the resources of a reporting enterprise or entity, and also the claims against the entity, in other words, the liabilities against the entity, and the changes in the resources and the claims that meet the definitions of the elements of financial statements. Objective and the scope of financial statements. The main objective of financial statements is to provide financial information about the reporting entities' assets, liabilities, equity, income, and expenses that is useful to the users of financial statements. The information provided in the financial statement is provided in the statement of financial position by recognizing assets, liabilities, and equity. Statement of financial performance, which is regarded as the statement of profit or loss and other comprehensive income, by recognizing income and the expenses, and then other statements and the notes. Reporting period. You find that the financial statements of an entity or a business enterprise are prepared for a specified period of time, which is known as the reporting period. Comparative information for at least one prior reporting period must be supplied in the financial statements. The going concern assumption. You notice that the financial statements are normally prepared following an assumption that the reporting entity is a going concern, and they will continue to operate in the foreseeable future. This means that the entity has neither the intention or the need to be liquidated or to cease trading. Where an entity has such an intention, that is, an intention to liquidate or cease trading, the financial statement may have to be prepared on a different basis, and the financial statement should describe such a basis. The reporting entity. You'll find that a reporting entity is an entity that is required or that chooses to prepare financial statement and is not necessarily a legal entity. When a reporting entity is not a legal entity, the boundary for reporting is determined by the information needs of the primary users of the reporting entity's financial statements. But as regard a legal entity, you notice that there are normally some prescribed information or there are some prescribed financial statements that are supposed to be prepared. Normally you find that the law that governs businesses or companies who specify as to the financial statements that are supposed to be prepared, and also from the International Financial Reporting Standards, there are also some prescribed financial statements that are supposed to be prepared, and this will normally be demanded by the governing laws of some jurisdictions, and as such, those legal entities will have to follow what the law requires. If it requires that the financial statements of a reporting entity are supposed to follow international financial reporting standards, then the entity has to follow that. Elements of financial statements, according to the conceptual framework, the elements of financial statements include, among other things, assets, liability, and equity, which relate to the reporting entity's financial position, and income and expenses, which relate to a reporting entity's financial performance. I think in our next topic, after the conceptual framework, I will be able to define what these elements of financial statements mean. In other words, I will define assets, liabilities, and equity, income, and expenses, so that we can be able to understand them. Recognition and derecognition. Recognition is known as the process of capturing for inclusion the statement of financial position an item that meets the definition of one of the elements of a statement of financial position, that is an asset, a liability, or equity, or in the statement of financial performance, an item that meets the definition of the elements of the statement of financial position, that is income and expense. Therefore, the recognition criteria is as follows. An item is recognized if it meets the definition of an asset, liability, equity, income, or expense. Recognition must present useful information, must be relevant and faithfully presented. Then derecognition. Derecognition is the removal of all or part of an asset or a liability from an entity's statement of financial position. This normally takes place when the item no longer meets the definition of an asset or of a liability or of equity. An asset is derecognized when the entity loses control of all or part of the asset, and a liability is derecognized when the entity no longer has a present obligation for all or part of the liability. Measurement. The conceptual framework requires the elements recognized in the financial statements to be quantified in monetary terms. This requires that a measurement basis be selected. A measurement basis is an identified feature of the item that is measured, and it creates a measure for the asset, liability, income, or an expense item. Due to the qualitative characteristics of useful information and the cost constraint associated with this information, different assets, liabilities, income, and expense items are likely to use different measurement bases, of which we will discuss the measurement basis shortly. Measurement basis. There are a number of measurement bases when preparing the financial statements. We'll focus on two, that is historical cost and the current value. With regard to historical cost measures provide monetary information about assets, liabilities, income, or expenses using information derived from the price of the transaction or event that gave rise to the item. Historical cost does not reflect changes in values, except for changes relating to impairment of an asset or a liability that become onerous. A liability is onerous if the historical cost no longer depicts the full obligation. So the historical cost of an asset is the value of the costs incurred to acquire or create the asset plus transaction costs. The historical cost of a liability is the value of the consideration received minus the transaction costs. Then the current value, according to the framework, the measurement basis is current value, and this basis include fair value, value in use for assets, and the fulfillment value for liabilities, and the current costs. The qualitative characteristics of useful financial information. The qualitative characteristics are the attributes that make the financial information useful. To be useful, the financial information must be relevant and faithfully represents what it purports to represent. Useful information is enhanced if usefulness is enhanced if the financial information is comparable, verifiable, timely, and understandable. Fundamental qualitative characteristics. The conceptual framework lists the following fundamental qualitative characteristics, that is relevance and faithful representation, and I think I will deal with this in turn. Relevancy. Relevant information is capable of making a difference in the decision made by the users. Financial information is capable of making a difference in decisions if it has predictive value, confirmatory value, or both. Predictive value entails that it can be used to predict future outcomes, while confirmatory value entails that the financial information provides feedback about previous evaluation. Another important aspect which relates to relevance is materiality. Materiality is based on the nature or magnitude of the information in the context of the financial statements of the entity. Information is material if it is omitted or misstated. It could influence decisions that primary users make on the basis of the financial information. As a result, a uniform quantitative threshold is not prescribed. A faithful representation. Financial reports represent economic phenomena in words and numbers. To be useful, financial information must faithfully represent the substance of the phenomena that it purports to represent. To be a perfectly faithful representation, a depiction could be complete, neutral, would be complete, neutral, and free from error. A complete depiction includes all information necessary for a user to understand the phenomena being depicted, including all necessary descriptions and explanations. A neutral depiction is without bias in the selection or presentation of financial information. It is not slanted or weighted, emphasized, or in any way manipulated, but has purpose and can influence behavior. Neutrality is supported by the exercise of prudence, which implies the exercise of caution when making judgments under uncertain conditions. Prudence means that assets, income, liabilities, and expenses should not be over or understated. Faithful representation does not mean accurate in all respects. Free from error means there are no errors or omissions in the description of the phenomenon. The process used to produce the reported information has been selected and applied with no errors in the process. When amounts cannot be observed, it must be estimated. Reasonable estimates do not undermine the usefulness of information if the estimates are clearly and accurately described and explained. Enhancing qualitative characteristics. The following are qualitative characteristics that enhance the usefulness of information that is both relevant and provides a faithful representation of what it purports to represent. That is comparability, verifiability, timeliness, and understandability. Comparability. Information regarding a reporting entity will be more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or date to enable the users to make an informed decision. For example, in which entity to invest or keep an investment in a specific entity. Comparability is a qualitative characteristic that enable users to identify and understand similarities and the differences among items. Comparability does not relate to a single item. Comparison demands at least two items. Consistency, although related to comparability, is not the same. Consistency refers to the use of the same method for the same items, either from period to period within a reporting entity or in a single period across entities. Comparability is the goal. Consistency helps to achieve the goal. Comparability is also not uniformity. Like things must look alike and the different things must look different for information to be comparable. Verifiability. Verifiability entails that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. Verifiability assists or it helps ensure users that information faithfully represent the economic phenomena it purports to represent. Timeliness. Timeliness entails having information available to decision makers in time to be capable of influencing their decisions, and the older the information is, the less useful it generally is. Understandability. Financial reports are prepared for users who have a reasonable knowledge of business and economic activities, and who review and analyze the information diligently. Classifying and characterizing and presenting information clearly and concisely makes it understandable. The cost constraints on useful financial reporting. Cost is a pervasive constraint on the information in financial reports. The cost of providing financial reporting must be justified by the benefits of reporting that information. Users ultimately bear the costs in the form of reduced returns. It is obvious that the benefits derived from information in financial reporting should exceed the cost of providing it. The concept of capital maintenance and the determination of profit. The concept of capital gives rise to two concepts of capital maintenance as shown in the table below. The financial capital maintenance. In terms of this concept, profit is earned if the value of the net assets of an entity, that is the equity of an entity at the end of the accounting period, is greater than the financial value of the net assets or equity of the entity at the beginning of the accounting period, after excluding any contribution to and the distribution from owners during the accounting period. So in other words, we are saying equity at the end of the accounting period minus equity at the beginning of the period, without taking into account the contribution by the shareholders or distribution to the shareholders, will show a profit or a loss. Then physical capital maintenance. Under this concept, a profit is earned only if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity at the beginning of the period, after excluding any contributions by the shareholders or distributions to the shareholders during the period. That's the end of our presentation. Thank you so much for watching the video. I encourage you to subscribe to the channel and hit the notification bell, so that whenever I upload a new video like this, YouTube will be able to notify you. I also want to say, in our next video, I am going to discuss financial position, or the financial position. So don't miss out on the next video. And once again, I encourage you to subscribe to the channel. And for those who have subscribed to the channel, I thank you so much. Your subscriptions mean a lot to the channel. Thank you so much.